freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, how you doing today?
I'm doing great. It's mostly sunny here in California.
Well, that's nice. We've had a nice day here, but we're expecting snow here in East Tennessee. Yeah, so
at least the water's not at 40 feet anymore.
Well, that's very true. We had that in the fall, and there was the crazy flooding happening recently up in Kentucky. It seemed like a lot of the same stuff had happened back here in the fall. So yeah, wild weather. Anyway, today, love to talk about a topic that I'm certainly passionate about. You've heard me vent a few times, and that's my love-hate, but mostly hate relationship with the lovely metric known as the internal rate of return, or IRR. So I'm not the biggest fan of the metric as a whole. Like, I think it's an okay metric, but I think it gets misused a lot. So yeah, I want to dive in on that a little bit more. I've definitely got a lot to say on this topic. I don't know, Adam, if you've got anything off the bat you want to share.
I think it's an interesting topic, specifically around the fact that so many people hold it so close to how they measure deals, right? Like they'll completely write off a deal if the IRR is either way too high or way too low, and you're measuring it against a pro forma, which is just a bunch of assumptions, right? I mean, pro forma is an assumption. And so the IRR is literally like sometimes thousands of assumptions all boiled down into one metric. And you can change some of those very baseline assumptions and end up with drastically changed numbers that are nowhere near what you would expect to get. Yep. So I think that's one of those things that, yes, it is a valuable metric, but you really have to, it comes back to the education, right? You've got to understand what you're looking at.
Absolutely. And you touched on a lot of the main points that I kind of want to hit on as well, but I guess at a high level, let's describe what it is. And I suppose we can, I do have a newsletter edition that I wrote on this, and I've got some graphics.
You write a lot of newsletters.
What's that?
You write a lot of newsletters.
I do. I write one every week. PassivePerspectives.com if you want to sign up. Would love to have you join there if you're not already subscribed. But yeah, I wrote about this, I don't know, sometime last year, and so the internal rate of return is designed. It is purposefully designed to be very flexible to where it can measure a lot of different things, right? Like we talk about it a lot here with investing and real estate specifically, but you can also use it if you are inside of a business to measure the potential return or the viability of some kind of like internal project, right? Or some investment there. And realistically, all it is it's looking at cash flows over time. And so it's not like if you hear someone say an average return, a lot of times that is cash flows over time, but that mushes them all together. In IRR, it looks at specifically when the cash flows happen.
It's got the rate, right? That's the rate part of internal rate of return.
Exactly. So it's not just like that the cash flows have happened over a period of time. It's specifically when in that time frame did the cash flows occur. And that timing influences what the IRR is. And it generally, the reason people like this is it starts to pay back the initial investment, or it's measuring the payback of the initial investment. And the sooner that starts happening, the higher the IRR. So in instances where the return is all at the end, even if the dollar amounts are exactly the same, the IRR will be lower than if that return all happened earlier. And again, I'll link to the article I wrote on this. I've got a little bit of an illustration where the dollar amount returns and the average return for two different types of investments are the same, but based on when the cash flows of the returns happen, it influences the actual IRR number.
And that's another thing, where it makes a lot more sense to, once again, understand the investment, understand the metrics that you're trying to track. Because if you're just looking at two different IRRs and you're like, well, this one's higher, maybe it's a development deal that's got a crap load of cash flow at the tail end, but there's no cash in the interim. And if you want cash flow, then it doesn't matter if that IRR is higher because you're not getting any cash in the interim, right?
Exactly. And that really gets into the problem that I have with it, is because that even aside from the timing, like all of that just gets completely blown away and just mushed together, really, when you're just looking at this single number. And it's why you made this point earlier, Adam. Like, I don't like when people are just, if the sole thing they're looking at is comparing the IRR between two deals. You really can't do that, because even if you're looking at, say, two value add multifamily deals, no two deals are exactly the same. You still need to dive into the details of each of those to know, okay, what's actually driving those returns. And so again, like knowing the components of when the return comes, that's very, very important, right? And you mentioned this. If you've got a development deal where the return is all at the very end, then that's a different kind of return profile than something that's a cash flowing type, a value add apartment building or something like that.
What was it that Robbie said on that last call where he was, he had been talking to that investor, and he was like, 2 years into an investment, he's like, I know you said this would take a while, but I didn't know this development deal was going to take a while, right? So, if you're just comparing the high level numbers, that might not be exactly what you were expecting.
Spot on. And that's the thing. And that comes back to knowing yourself, knowing like the types of investments that you're looking for, knowing if you've got different portions of your capital that you want to deploy, and you want that to have a certain type of return profile, that has to match how you're deploying it, right? The actual vehicle you're deploying that into. And simply looking at IRR will not tell you that. You've got to dive deeper. And I think that's a mistake. Again, a lot of folks are like, well, if that becomes their initial filter, it's fine to look at. Like, it's fine to if you want to filter deals on that, right? I mean, if I had something come across my desk and it was a 3% IRR, I'm probably like, unless it's T-bills, which even then I wouldn't do, because I know I can go do that directly, like hire myself. So I'm not saying that you should like not use it as a filter, but like, it can't be the only filter, right?
We also have value-added multifamily deals that we look at and that we do where the IRR at year 5 or 10 isn't great because we're not selling it, right? We are planning to cash out refinance, and that doesn't give you some massive upside. We have to leave equity in the property. The whole idea is a long-term hold, so it also then plays into what's the strategy of the investment.
Yes. And how's your capital being returned, and what for the purposes of that IRR calculation, where's that cash flow coming from? Is it cash flow from operations? Is it a standard, again, cash flowing apartment building and able to make distributions, and that there's a portion of the return that's being supplied just by regular ongoing cash flow? Is it a refinance that's returning 70, 80, 90, maybe 100% of the original investment? Because that is a cash flow for the purposes of IRR. Or is it, we have done something, we've increased the value, and we're selling it, and it's all happening at the very end? And so, like, again, that's sort of the first layer to know, is what's happening there. And then once you understand that, you can start to dive into the further layers of, okay, well, what are the assumptions that are going into this?
So I think all of this is a very fascinating discussion for the two of us who really like numbers. And, a lot of our viewers are engineers and in the software field, so they probably appreciate this. But I think at the end of the day, what we're saying is that we don't base our decisions off of one metric, super high level. Even when I go look, there's deals that I put money into. Me and you did an oil deal at the end of last year where we didn't do as deep of a dive when we weren't raising the money, right? We looked at it, we understood the investment, and we're like, yeah, the numbers seem decent, but it wasn't just the one screenshot we got that said, your returns are going to be 2.6x multiple, right? There wasn't even an IRR on it, but we dove a little deeper. We understood the asset, we understood how we got our money back, and the type of investment, how they generated the cash flow, who the operator was, what their track record was. And even in some of the oil and gas deals, and even true with apartment deals, is how does the cash flow that's generated flow, right? Because in some oil and gas deals, it's, let's say, the one that we did, we'll just use that as an example. We don't have any passive investors in it, but we've got, we are the passive investor. We invested through a group who then pooled all their money together and bought working interest that's then managed by EOG. And so we're not an operating working interest. We've got an operator that generates cash, but really there's someone on the ground producing oil that then gets sold. The cash has to go to a bank account, go to the management company. Okay, well, let's hope there's no fraud there or anything that goes away, right? These are all things you've got to at least think through. Like, it's really cash that has to hit a bank account and move to the next layer, right? And so from EOG, then it goes to the asset manager. Okay, well, then that's got to go to the right spot and get divvied up correctly. And then from there, it's got to go out to all the individual investors, right? And with us, we have a partnership that then is going to go to me and you. So then, one of us have to decide how we're going to split up that cash flow. So there are a lot of layers that I think really, if I tried to drive to a point of what we're talking about here, is that one metric at the high level, and I think this is your frustration, when we have investors come to us and be like, your IRR is just lower than this other group, and you're like, really? Well, but like how? Well, it's 50 basis points lower. Okay, well, how are the investments different, right? Which cash flow plan do you believe is more likely to hit those returns, right? Because if you want the IRR to show you 100%, I can make that happen. I just don't think I'm going to hit it, right? Yep. But I can show you the number.
Yeah, no, and I think that gets to the next big thing that bothers me about this is like how, again, if you don't understand the layers that are going into that number, then it's hard to understand how easily the number can be engineered. And we've talked about this before, right? That if we're talking to investors and they're like, well, I wish it said this. And it's like, okay, well, we can change the exit cap rate and easily make it say that. And I think that's where if you're looking at any kind of investment, and especially if most of the returns are backloaded. And so they're coming from usually a sale in, let's say, year 5, right? That's the standard apartment syndication. Double your money in 5 years, right? If most of those returns are coming from a sale in year 5, then you've really, really got to dive into the assumptions on the sale. What's the price per door at that? What's the projected price, like sell price and the price per door? Is that realistic? Do we think the rest of the market's going to be there? What's the cap rate? What's the debt situation look like over that time period? Is there some sort of, is it a 5-year debt or is it going to have to be refinanced at some point in time in the middle? And now there's this lurking time bomb in year 3 that's going to have to be overcome in order to make sure that you actually get to year 5.
Well, and from 2021 to 2025, that's a great example. They had the multiple correct, or the times 2, the 2 on the multiplication side there, but it just needed to be divided by 2, not times 2, with the way cap rates moved in the last 4 years.
Going in the wrong direction for sure. But that's again why I just, every time I see this and I see folks that are evaluating this, I think it just, again, it might be a good starting place to start a conversation, but that's really all it is, right? It can't be the filter for investing in a deal. It never would be for me. It would be, again, the starting point of a conversation. I want to understand, okay, what is that? What makes up the components of that? But then again, the deeper levels, start going through the layers. What's the cash flow look like? What are the exit? If most of those returns are coming on the exit, what are those assumptions? Are those realistic? So really asking a whole lot of questions and not just relying on any single metric. I mean, I like to pick on IRR because I think it's probably the most egregious of these, but there's, Adam, to your point earlier, there wasn't one single thing that we looked at in the oil deal that we're like, okay, we're going to invest in this. It was like, no, we're going to question all these different pieces in it. And then once we're comfortable with the entire picture, then we move forward. I hate seeing it. You get people that... I hate having to answer this question because, again, of my strong feelings about it. But at the same time, we also, if we don't, we know, being on the sponsor side of these deals, if we don't provide an IRR, then there's going to be people who just won't even look at the deal because that's not there. So we know it's a number that we have to provide. And then for us, for our type of investing, I think this is another thing that bothers me. If we're targeting an infinite hold, that naturally, because of the fact that the cash flows are more spread out, that will tend to create an IRR that's lower, and we almost have to manufacture a sale to...
And that's what we show normally, right? We show a hypothetical sale IRR price. That's what we normally show at year 5 through 10.
Exactly. And the only reason we do that is because of so many investors expect to see that number, even though that's not the way that we look at the types of investments that we do. But we, in some ways, have to back into a number. And all of the assumptions that come with that, right? And we're very forthright about the fact that, like, look, we're going to show you this, but you need to understand that there's a whole lot of assumptions going into this that we don't control.
And
so we're showing you this so that
so this IRR doesn't make a whole lot of sense.
Exactly. But it's not, and again, this all goes back to like why it's important to understand why you're investing, what you're investing for, what your objectives are, and that the deals you're investing in line up with that. And one single metric is not ever going to be able to answer that question for you.
I don't have anything else, but I think it's an interesting topic. I think if there's something specific that an investor here or a listener here has questions about, and reach out to us, and we'll dive in more. Send us an email, and we'll discuss it on the next show.
Yeah, absolutely. Now we'll keep this one short and sweet, but yeah, just keep that in mind. If you ever find yourself evaluating a deal on a single metric, and especially if it's IRR, just stop, take a step back. I think of the Michael Jordan gif. Stop, get some help.
If the metric is current in-place cash flow when you acquire it, and it's over 10, that's maybe a different metric to be looking at. If that's the one metric to look at,
for sure. And that's a much lower risk and lower assumption driven metric.
Yep.
Yeah, it's a great point. Well, we'll conclude it with that. I don't suppose there's any reason to keep beating this horse. I think everyone understands how passionate we are about this. But as Adam said, if you got questions or anything about this, or if you've seen a deal that you think might be especially egregious, we'd love to look at that. Maybe we can kind of anonymously tear it apart here on a future episode. But definitely reach out if you got questions. We'd love to hear from you. But we appreciate everybody joining, as always. We'll see you on the next one. Just remember, where freedom leads, real wealth follows. Thanks, everybody.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.